Do you want to be rich, retire early on the beach, have your money work for you instead of you working for your money? This may sound like the dream for many, but at the same time, most people assume that you have to be a hotshot CEO to get to the point of financial peace. Today, we're going to talk about the only investment structure that you need to get to that point, and it doesn't require you to be a corporate executive to get started with it. Once you have the structure for these investments in place, it's simply a matter of controlling your spending, adding to your investments, and waiting until you've accumulated enough money to let compounding interest do the work for you. Thousands of people have used this type of investment portfolio to reach a point of financial independence, and you can too if you get started investing today. The investment structure that I'm referring to is called the three-fund portfolio, otherwise known as the lazy portfolio. The gist of it is simple, and executing on this investment structure is as simple as the concept of it. The idea is that you diversify your investments across domestic stocks, international stocks, and bonds. By investing in a diversified fund in each one of these three asset classes, you are splitting your investments across tens of thousands of companies and bond issuers. This much diversification protects you from any given company tanking your investment portfolio and makes the growth of your investment centered around the growth of the global economy, a bet that has worked out for those who have taken it for over a century now. Let's jump into the components of the portfolio to talk about why each one is important. First, let's get started with domestic stocks. Domestic stocks are the largest part of the portfolio for many people. Assuming that you are based in the United States, domestic stocks have proven to be extremely lucrative over the past century. These are companies like Apple, Facebook, and Amazon, to name a few, that have been helping the US economy continue to grow at insane rates in recent years. The S&P 500, an index that tracks the 500 largest companies in the United States, has grown at an average of roughly 11% since its creation almost 100 years ago. Although stocks are volatile and this growth percentage will vary wildly from year to year, most people consider it a safe bet that over the long term, holding a fund that covers a broad range of domestic stocks will lead to significant growth. The next asset class in the three-fund portfolio is international stocks. This one may sound controversial to some, but it is generally considered a good idea to have a portion of your portfolio be in international stocks. Many people look at the recent performance of international stocks and scoff at the idea of investing in them when compared to US stocks. But when you look at the big picture, the reasoning for investing in international stocks becomes much clearer. Although the US has extremely strong performance in the past, international stocks also go through periods of strong growth as well. In fact, the two groups typically trade periods of higher performance in a cyclical fashion. It's a good idea to keep anywhere from 10 to 30% of your investments in international stocks so that when either grouping of stocks is up, you get to reap the reward, but at the same time, you are protecting yourself from losses by diversifying. It should be noted that one reason that international stocks are riskier for US investors is that you are also subject to changes in valuation of international currency. This adds a layer of complexity to the investment and could work to your benefit or it could hurt you, but either way, it makes it slightly riskier. Because of this, you generally want international stocks to be a smaller portion of your portfolio than domestic stocks. Before we get into the last asset class, I just wanted to thank you for tuning in and say that if you're liking the content, please hit that like button, drop a comment below, and subscribe. All of these actions help the YouTube algorithm promote the channel and help us expand the reach of our message of financial education. The last asset class in the three-fund portfolio is a bond fund. Bonds are traditionally known as being a safer investment, especially if you diversify among a large amount of corporate and country bonds. Their yield is more consistent than stocks and will generate good passive income for you if you are in retirement, and they will not take as large of a hit if the economy crashes. This protection of your portfolio value becomes much more important as you get older and closer to retirement, so it's common to increase your bond allocation as you get older. Now that we have gone over the three asset classes, how should you allocate your investments between them? Generally, when you are young and have several years or even decades before you want to touch your investments, you will heavily skew towards stocks. For someone in their 20s, this could mean 80 to 90% domestic stocks and 10 to 20% international stocks. As you get older, you will want to introduce those bonds into your portfolio and steadily increase them to protect the value of your investments. There's no magic number for the final allocation of your investments when you reach retirement, but 40 to 50% domestic stocks, 30 to 40% bonds, and 10 to 30% international stocks are ballpark numbers that many people follow. If you're curious about what are the actual funds behind these investments, here's an example for someone who invests with Vanguard. Your domestic stock fund would be VTSAX, your international stock fund would be VTIAX, your bond fund would be VBTLX. If you want to know the equivalent of these funds at the other popular brokerage firms, check the description. There are so many advantages to the 3-fund portfolio, it's hard to even fit in one video. Just to list off a few, it's an easy investment structure, you are heavily diversified which decreases risk, the fees on your investments are extremely low, your investments are tax efficient, you don't have to worry about a bad investment manager, there's no overlap in investments, it's easy to rebalance, you are always in line with the market, and most importantly, mathematically, you will outperform the vast majority of investors. Well, that's a lot of upside. Although there are no major downsides to this investment structure, I still feel obligated to present to you the devil's advocate point of view. The only real disadvantage to this investment structure is that you won't get rich overnight. It will take you years of investing your money in order to reach financial independence. On the bright side though, this is a more reliable method than any other method out there. Any investor who tells you that you can get rich overnight is also presenting you an option that has a high likelihood of you losing all of your money overnight as well. This isn't magic, it's investing intelligently for the long term. If you want to read more about the 3-fund portfolio, check the description for more resources. Don't forget to like, comment, and subscribe to support the channel. Thank you for tuning into the Money Minute.